The stock market's been a bit choppy as we near the end of the first quarter of 2025 with escalating trade tensions and concerns about possible stagflation. How will the markets fare over the rest of 2025? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update. The date today is March 17th, 2025, and today we'll be discussing what we believe to be the main factors driving stock and bond markets today and going forward. My name is Paul Latta. I'll be doing the speaking today, but my business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. We'll begin today with a discussion about the recent market action, stocks, bonds, and other assets. Then we'll look at the macroeconomy to add some support behind the market discussion. Then we'll move to a microeconomic view and look at key industry-specific drivers. Then we'll conclude with some longer-term observations about the investment landscape. The S&P is down 3.5% year-to-date through March 14th, as shown on the left. While January started strong, the months of February and March so far have seen a reversal of those gains amid escalating trade tensions and fears of stagflation. Last week, the S&P briefly declined just over 10% from its recent high and briefly entered into a correction territory. The chart on the right, however, shows the pullback on the S&P in recent weeks is, well, it's fairly small compared to the gain over the last 5 years, up 155.4%. The bond market is up 2.1% year-to-date, as shown on the left. Much of the bond market gain was due to asset allocation changes, that is, moving assets from stocks to bonds amid a more risk-averse environment. So bonds were up and stocks were down. Over the last 5 years, the bonds are down 2.7%, as shown on the right. The bond market is still below its 2020 highs when central banks around the world cut rates to near zero amid the COVID pandemic. Speaking of central banks, this chart shows the Fed funds rates over the last 10 years. The Fed started cutting rates in September last year, but rate cuts have not been as fast as rate increases back in 2022 and 2023. We did see 3 rate cuts in the last 4 months of last year, in September, November, and December, but we've been in a holding pattern since that last rate cut in December. The Fed is proceeding cautiously here amid fears of a second wave of inflation, similar to what we experienced in the late 1970s. Trade tensions, especially regarding higher tariff levels, are also adding to the cautionary tone at the Fed. This table is from the Chicago Mercantile Exchange, and it shows probabilities of future Fed rate changes based on Fed funds futures. As you can see here, the market expects the next rate cut at the June meeting, another at the September meeting, and a third at the December meeting. That will bring the Fed funds rate to 3.5 to 3.75%, which is 3/4 of a point below the present level of 4.25% to 4.5%. This table can be fairly reactive. In January, the consensus was only 1 rate cut for the year, but the recent escalation in trade tensions has increased the dovishness of the street. Seems investors are slightly more worried about stagnation and recession than they are about a second wave of inflation. By comparison, the Fed dot plot is a little less dovish, with the consensus among Fed governors right now just below 4% by year end. Most global central banks are either cutting rates or holding rates steady. Very few are raising rates. The U.S. has been in pause mode since December, partly on the lift in CPI inflation in January up to 3%, and partly on tariff uncertainty. Europe inflation of 2.4% is actually very close to the 2% target, and the European Central Bank has been more active in cutting rates. That said, there is some disparity within Europe, as Western Europe generally remains below target and Eastern Europe generally remains above target. This partly reflects the eastern periphery of the European Union bordering on Ukraine. In our prior slideshow from December, we chatted about the rise in inflation in India due to food inflation, but the increased food prices have since softened and the central bank is now in rate-cutting mode. Brazil has seen a similar trajectory to that of India, with higher inflation last quarter, which has since softened, allowing the central bank to be less hawkish. However, the inflation spike last quarter was related to housing and electricity prices in Brazil, not food prices like in India. And the Brazilian central bank has been not cutting rates, but has simply stopped raising rates. This is the yield on the benchmark 10-year Treasury bond over the last year. What we find interesting on this chart is that the yield on the 10-year Treasury has tracked the stock market higher and lower with a fairly tight correlation, but only over the last 6 months. That's the sign of an earnings-driven market. However, in the prior 6 months, the yield on the 10-year Treasury tracked in the direct opposition to the stock market. That's the sign of an interest rate-driven market. Why did the market shift in September of last year from being interest rate driven to being earnings driven? The paradigm shift reflected the dominant narrative of the time. Recall in September of last year, the Fed made its first rate cut since emerging from the COVID pandemic. So interest rates were the dominant narrative in the months leading up to that change, and the stock market then tracked in the opposite direction of interest rates. But once the new Fed policy was old news, the narrative shifted to earnings narratives. In particular, how earnings will fare under a new Trump administration, and then how earnings will fare amid increased tariffs. With these earnings narratives dominating, the stock market has been tracking the rate on the benchmark 10-year Treasury, both higher and lower. While most investors know that stock prices are really only about two things, earnings and interest rates, it is a little unusual to see such a black and white paradigm shift from a rate-driven market to an earnings-driven market. Usually the shifting is more nebulous, with many short-term reversals and changes along the way. The 10-year Treasury yield on the prior slide is now just over 4.2%, almost 4.3%. However, those rates may be on the low side by perhaps 0.5 percentage points. Why is that? Well, it seems the budget cap has been forcing the Treasury to draw down a special line at the Federal Reserve instead of issuing bonds. The squelching of bond issuance is material and about $350 to $450 billion per quarter. Less bond supply means higher bond prices, which means lower bond yields. That means that when the budget cap finally resolves, it's likely we'll see rates on the benchmark 10-year Treasury lift, perhaps on the order of a half a percentage point or 0.5%. Let's return to the stock market and the key factors driving investment there as shown here. We've already discussed interest rates, but let's look at these other factors too. Let's begin with valuation. This chart shows the S&P 500 over the last 10 years in blue and the valuation of the S&P 500 over the last 10 years using the price to earnings ratio in purple. As you can see, the S&P 500 has done well over the last decade, lifting an impressive 234.2%. Some of that is due to elevated valuation, as shown in purple. The present price to earnings, or PE ratio, is 20.4, which is modestly above the middle of the 10-year range of 14 to 24 times. The recent pullback in the stock market in the last month has dropped the valuation multiple by almost 10%, which seems to make for a more attractive entry point. That said, this does assume that the earnings do not get revised lower amid the uncertainties of a trade war. Stock and bond valuations have converged substantially in recent months. Here we compare the earnings yield on the S&P 500 stock market index to the yield on the benchmark 10-year Treasury bond. Whichever line is higher is the better value with this approach. It seems our elevated rate environment over the past several years and the present modestly elevated stock market valuation have now converged for the first time in nearly 20 years. The red line and the blue line are nearly at the exact same level. This most certainly increases the attractiveness of bonds, and with more rate cuts from central banks likely in the offing, the bond market seems especially timely. Market breadth has recovered nicely in recent months. Here we look at market breadth going back several decades, going back to 1980, by simply measuring what portion of the S&P 500 stocks are actually outperforming the overall S&P 500. As we've discussed before in prior slideshows, 2023 and 2024 were two of the narrowest markets in history, with just a handful of large stocks responsible for the bulk of the move in the overall S&P 500. The big movers were the so-called Magnificent Seven, included Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla. Most of the remaining 493 stocks in the S&P 500, well, they underperformed. From the perspective of an active investment manager, an extremely narrow market effectively shrinks the dartboard, a very challenging environment. However, in 2025, many of the Magnificent Seven names began to reverse. The effect has been a substantial broadening of the market back to a more normal levels where just over 50% of the names in the S&P 500 outperform. For active managers, the dartboard is back to normal size. Not oversized, just normal sized. Stock market volatility spiked in the last month, with the VIX volatility index lifting to over 26, as shown here, mainly related to the fear over U.S. trade policy. That does put the VIX at a 6-month high, not as high as the spike to over 37 that we saw this past summer when the Bank of Japan surprised the world with a rate increase that unwound the so-called carry trade, a key driver of the rally in the Magnificent Seven stocks last year. That said, the Bank of Japan reversal was digested fairly quickly last year. However, the trade policy back and forth does not seem like a one-time adjustment, and volatility may be elevated for some time. Investment returns in 2025 by sector so far show that the defensive sectors are outperforming the more aggressive growth-oriented sectors. So healthcare and utilities are outperforming, but technology and consumer discretionary sectors are underperforming. Notably, the Magnificent Seven names are heavily overweighted in three sectors: technology, consumer discretionary, and communications, all of which are down for the year. The style factor breakdown year to date also shows a defensive posturing, with the low volatility style leading the pack so far, followed by income and value. The more aggressive styles like high beta and story stocks are lagging the market. It's interesting to compare the style factor performance in the first quarter to date with the down markets of 2018 and 2022. Today's down market seems to overlap a little closer to that of 2022 than that of 2018. The main difference between 2018 and 2022 was that the Magnificent Seven stocks outperformed in 2018 but underperformed in 2022. We suspect the remainder of 2025 is more likely to look like 2022, albeit with more of an earnings narrative instead of an interest rate narrative. However, the Fed does have many bullets in the gun, so there will be some back and forth with the narrative over the course of the year. The U.S. market has meaningfully underperformed most other global markets in 2025 so far. This is quite a contrast to the so-called U.S. exceptionalism of the prior 2 years. This appears to be mainly related to fears over the new and isolationist trade policy of the U.S., fears which are driving capital flight away from U.S. capital markets. In addition, there is some discussion of the generative AI theme losing some steam after some sizable prior year gains. China markets have done well in the first quarter to date. This reflects a combination of strong stimulus measures late last year, as well as headlines around the new DeepSeek generative AI technology. Europe bourses are also up quite strong in the first quarter to date, mainly reflecting capital outflows away from U.S. capital markets amid controversial trade policies. A more dovish central bank has also been helpful in Europe. Latin America bounced in Q1 to date, partly reflecting oversold conditions for last year on tariff threats and immigration issues. India is one of the few markets in the world underperforming the U.S. market. U.S. reciprocal tariffs on India have been a headwind. This is especially problematic since so many investors sought out India as an alternative to China amid China tariffs. India now seems less likely to be as competitive. We'd now like to move on to part 2 of our slideshow today, the economy. We'll begin by looking at GDP levels by country. The global economy in the fourth quarter has been moving forward, albeit slowly, muddling along, if you will. US, Canada, and Japan have been above average in the fourth quarter. Europe is the only region in the world showing select areas of contraction, as shown in red. The weakness in Europe seems to reflect a combination of proximity to Ukraine as well as ongoing and related energy issues. Mexico and Brazil remain on the soft side due to currency and central bank headwinds, but growth remains above zero. China and India, too, are posting positive growth, albeit growth that is a little bit less than their historic averages. Inflation is moderating in most countries. Notably, 2 countries have reached the target 2.0% or below inflation rate, Canada and South Korea, and the European Union is very close at only 2.4%. That said, there have been some signs of a possible resurgence in inflation. We've seen small upticks in monthly inflation figures in the UK, Japan, Mexico, South Africa, and even Canada. In light of the sizable second wave of inflation that we saw in the late 1970s, economists are casting a keen eye on whether the recent small upticks are signs of another wave. In fact, new tariffs could very well aggravate a possible second wave of inflation. On the other hand, inflation may simply revert to low levels, reflecting effective central bank policy and perhaps economic weakness related to trade tensions. The trade tensions have led to an increase in the probability of recession. This chart shows a 40% chance of recession in the next year, according to the prediction markets. Bloomberg consensus has also lifted, albeit to a slightly lower 30% level. The driver has been increased policy uncertainty. The increased policy uncertainty has economists looking at those data points that have declined amid tariff changes. At the top of the list is the sharp drop in consumer confidence to a 3-year low. Also, we've seen a drop in CEO business confidence, a softening of the temporary help hiring, and the Federal Reserve of Atlanta, which compiles the GDP Now estimates, is forecasting a first quarter contraction in GDP, perhaps the harbinger of a recession. Of course, not all economic data points are soft. PMI services and manufacturing is still showing expansion. Housing prices are holding strong despite high mortgage rates, and innovation continues with forward progress in generative AI and GLP-1 weight loss and diabetes drugs. Of course, the Fed has a lot of room to cut rates should recession risk increase. This chart gets at the heart of the recent U.S. stock market weakness. The Economic Policy Uncertainty Index has spiked to an all-time high, with most of that due to changes in U.S. trade policy regarding tariffs. There are other factors, too, that are weighing on the U.S. markets and only the U.S. markets. Next on the list would be the new Department of Government Efficiency, or DOGE. Many of the cuts are reducing clarity over government enforcement and approvals and adding to the perceived riskiness of the U.S. market. With the increased riskiness of the U.S. market, perceived or real, defensive investments are likely to outperform more aggressive investments. Who are the winners and losers amid U.S. policy uncertainty? Winners will include investment-grade bonds, cash and money markets, and high-quality non-U.S. assets. Losers will include U.S. assets, especially the more aggressive stocks and high-yield bonds. Within just the stock market, defensive sectors and styles ought to outperform the more aggressive sectors and styles, so sectors such as staples, healthcare, and utilities ought to outperform technology, early-stage biotechnology, and consumer discretionary sectors. And styles like minimum volatility ought to outperform styles like high beta and story stocks. Tariffs are clearly dominating the narrative. This Bloomberg chart shows how often the word tariff was mentioned on transcripts of recent investor calls, and clearly you can see quite the spike here in the last several months. It also breaks down by sector, where you can see the industrials are basically fixated on tariffs, and far more so than any other sector, despite being smaller than many other sectors. In contrast, communications, a large sector that is virtually dominated by Google and Meta, well, communications has virtually no discussion about tariffs. This table is from JP Morgan's tariff tracker. A glance at the first 2 or 3 lines should make clear what we talked about in the slideshow last quarter. And across the board, 25% tariff on all Canadian or Mexican imports, well, it just won't work. Supply chains today are too complex. The parts that make up a car today cross the border on average 8 times before final assembly. Further, each new U.S. tariff will be met with retaliatory tariffs. In addition, there's clearly confusion on Main Street about who actually pays the tariff. A 50% tariff on Chinese import, well, that's paid for by Americans, not the Chinese. The higher post-tariff prices may be inflationary, and they may depress the economy with stagnation, or both with stagflation. With the complexity around tariffs across the thousands of import categories and jillions of possible retaliatory actions, the policy uncertainty in the U.S. is unlikely to dissipate quickly. There are 3 main categories of tariff targets as shown here. In the left-hand column, we have the countries that import a lot to the U.S., but they do not buy as much in the way of U.S. exports. This includes countries like China, Mexico, Vietnam, Canada, and Germany. All of these countries have been recipients of sizable new tariffs in recent weeks. This list is not exhaustive. There are more countries than the 5 just listed here. In the center column, we have the countries that may or may not import much, but have big barriers to U.S. exports. These are the countries that are targeted for the so-called reciprocal tariffs. On this list, we have India right at the top, followed by Brazil, South Korea, China again, and South Africa. Again, this list is also not exhaustive. In the column on the right, we have industry-specific tariffs regardless of the country of origin. Most of these industries are raw materials and intermediate goods industries with an emphasis on smokestack manufacturing industries, many of which have seen share losses to other countries in recent decades. Stocks within these 3 categories of tariff targets have not necessarily responded directly to tariff headwinds and/or tailwinds. Other factors, of course, such as capital flight from U.S. markets and fears of stagflation and other company-specific moves are also playing roles. While tariffs are dominating the narrative, the newly created Department of Government Efficiency, or DOGE, is also playing a role. This chart basically shows the DOGE mission in one simple picture. Federal spending lifted with COVID and remains above long-term average. How can that be lowered? That is the mission of DOGE. DOGE is targeting an impressive $2 trillion in savings. We suspect that goal is a bit ambitious, but also expect DOGE will make progress. DOGE has targeted federal spending at a broad level. As you can see, the list on the left here, the DOGE targets are widespread and not just aimed at a few big-ticket items. DOGE has its own website where it maintains a DOGE tracker of savings achieved so far. At present, DOGE is claiming $105 billion in savings so far. The biggest savings has been cuts to U.S. aid as well as cuts to Departments of State, Treasury, and Education. Newsweek is estimating that over 60,000 federal workers have been laid off so far. Naturally, there is some disagreement on the actual savings and the actual layoffs. NPR, in fact, is claiming that the actual savings is a fraction of the $105 billion in savings claimed by Doge, and the real savings is closer to just under $10 billion. Also, many of the 60,000 layoffs, those are being challenged in court, and they may need to be reversed. The ripple effects to government layoffs are complex and likely to impact most industries within the S&P 500 and beyond. We'll chat about this on the next slide. Doge is still in its early days, but some of the early moves portend how future moves may happen. One of the first sectors to drop on fears of Doge cuts has been the government contractors. There's more than a small handful of government contractors within the S&P 500. The list includes defense companies like Lockheed Martin and General Dynamics. It also includes consulting, staffing, and IT companies that serve predominantly government clientele like Booz Allen Hamilton, ASGN Staffing, and Science Applications. Doge also targeted cuts at the National Institute of Health, or NIH. Then the NIH cuts are still uncertain, but stocks of laboratory instrument makers like Thermo Fisher and Danaher dropped quite rapidly. So too did laboratory services companies like Illumina. While Doge impact on the dozens of other government services remains to be seen, one broad-based observation is that those businesses that depend on government approvals to move forward are likely to see delays in government approvals. Most businesses actually fall into this category. Getting permits for, say, drilling new oil wells, those are likely to be delayed. Getting drugs approved by the FDA, well, that's likely to be delayed. Getting environmental approvals for a real estate development project, well, that's likely to be delayed. So while Doge seems to be a necessary evil given government spending levels, its presence and activity is not likely to speed up business and seems more likely to slow business down. We'd now like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. We'd like to highlight 5 industry-specific discussion topics. As you can see here, banks in Europe, large language models, natural gas in the US versus Europe, the insurance cycle, and arbitrage spreads. Let's start with banks in Europe. Over the last 6 months, Europe stocks are up about 7%, well ahead of the U.S. market, which gained only 1% over the last 6 months. However, European bank stocks have roared 31.5% higher, an impressive gain given that banks were already the largest sector in the Europe market at nearly 1/4 of most European stock indices. Of course, Europe stocks in general benefited from the capital flight away from the U.S. equity markets amid tariff-related uncertainty, as we discussed back on slide 17. But why have European banks in particular been so much stronger than the rest of the European indices? Many of the headwinds on banks in Europe have been weighing on valuations for several years. On the right side of this chart, these headwinds included troubled bank balance sheets, the near-recessionary economy in Europe, the proximity to Ukraine and related challenges to the energy infrastructure in Europe, the challenges of the European Central Bank and its inability to unwind quantitative easing. But every sector has its day in the sunshine, it seems. As we can see on the left side of this chart here, the catalyst of U.S. policy uncertainty certainly drove big inflows into European stocks. And valuations of European banks were well below U.S. peers, making Europe banks far more attractive. Also, the European Central Bank recently cut rates, a more dovish environment than the U.S., which has not cut rates since late last year. Lastly, we believe Europe banks were especially prone to what we call reflex buying, a type of impulse purchase that we'll talk about in a couple of slides. But first, let's look at valuation in more detail. This table compares the valuation of the top 10 banks in Europe to the valuation of the top 10 banks in the U.S. Valuation is based on P/E ratios for 2025. What you'll see here is that the banks in Europe are trading about 20% cheaper than the banks in the U.S. And that is after the huge 30% outperformance in the prior 6 months in the Europe banks. If you go back 6 months earlier, the valuation spread was closer to 40%. In other words, the huge outperformance of European banks has cut the valuation discount in half, but it's not eliminated it. Europe banks are still the cheaper valuation. Peter Lynch, the famous investor from the 1980s and 1990s, made famous the line, "Invest in what you know." The idea here is that knowing an industry well means you have the advantage of familiarity, which can reduce risk and enhance returns. For people that work in the finance and investment industry, that means they really know finance and investment companies like banks, brokers, and insurance companies. Of course, European banks have trillions of euros of institutional buying power, and now with U.S. economic policy uncertainty increasing the relative attractiveness of European stocks, the European institutions are following Peter Lynch's advice and buying European bank stocks. And indeed, the European bank stocks are now the best performing sector in one of the best performing geographies. Will Europe bank stocks continue to outperform? It seems likely, though outperformance is likely to moderate, perhaps quite a bit. Europe bank stocks still remain undervalued relative to U.S. bank stocks, and of course U.S. policy uncertainty seems likely to remain perhaps for some time. European monetary and fiscal policy also seems likely to remain supportive. Europe bank stocks are not risk-free, of course. Bank stocks are always subject to black box risk, which could manifest especially in a slowing economy. The Ukraine-Russia war situation could always escalate. And of course, while there does seem to be some outperformance remaining, much of the outperformance is now behind us. Let's move on to our second industry topic, large language models. This does seem to be early days for the deployment of large language models, or LLMs. Indeed, ChatGPT was introduced not that long ago in November of 2022. Large language model revenue over the next 10 years is likely to grow perhaps as much as tenfold from the level seen in 2024. Not all large language models are alike. This table here shows many of the top LLMs and where the strengths for each lie. ChatGPT seems to be noted for its creative writing, coding, and chatbots. Also being one of the first LLMs of size, many other LLMs use ChatGPT for benchmarking. Google's Gemini performs well with combining text and images. DeepSeek is known for its low cost and rapid code generation. Each LLM seems to have its own unique set of attributes and personality features, and as the LLMs grow, the strengths and weaknesses change and evolve. Indeed, this table is a snapshot of a moving target. While large language model growth is likely to continue for some time, the LLM growth does not necessarily imply that earnings will also grow. There are roadblocks to translating industry revenue growth into company-specific profit growth. At the top of the list is the capital investment. The LLM business is a pay-to-play business that requires a significant upfront capital investment before returns can manifest. And most LLMs do not have especially high switching costs, meaning competition from other LLMs will cap profits. Also, LLMs are a new technology which can be subject to new and disruptive innovations like we saw with DeepSeek in January. Our read here is that certain of the pick and shovel plays are more likely to see actual earnings growth. NVIDIA, of course, has a unique AI offering that drives profit to the bottom line as a beneficiary of the capital investment of others. Companies with sizable cloud presence also want to see LLM growth translate into earnings growth, especially Microsoft, Amazon, and Google. To a lesser extent, other hardware companies with dominant positions in the value chain should also benefit, like Taiwan Semiconductor and ASML. We tend to avoid the electricity suppliers like Vistra, NRG, and Constellation Energy, names that are frequently cited as beneficiaries of AI data center expansion. However, the earnings growth in the last year or two has mainly been related to regulatory constraints on capacity auctions, which is completely unrelated to LLM growth. So we would tend to avoid the electricity suppliers as plays on LLMs. We would now like to move on to our third industry topic, comparing natural gas movements in the U.S. to those of Europe. This chart shows the price of natural gas over the last year with the U.S. prices in blue and Europe prices in yellow. Prices tracked each other fairly closely until the last 2 or 3 months. Why have natural gas prices been so strong in the U.S. but so weak in Europe in recent months? This is especially confusing since in December the consensus was the opposite, that Europe natural gas prices would rise and the U.S. natural gases would fall. Recall Ukraine shut its last Russian pipeline down in December last year, leaving Europe vulnerable. What happened? Well, it seems the known unknowns of natural gas made themselves known in the first quarter. U.S. prices rose on colder winter weather and on ripple effects of Trump's tariffs within the electricity market. That is, the U.S. electricity companies stocked up on natural gas to fuel their gas-fired generation if Canada was not able to import electricity amid the tariff uncertainty. In contrast, Europe prices dropped in the first quarter, partly on a warmer than normal winter, and partly on elevated natural gas stocking levels in anticipation of the closure of Russia's last natural gas line running through Ukraine. Where are natural gas prices headed from here? Our read is that the spread between U.S. and Europe natural gas prices will revert to normal, mainly due to falling U.S. prices rather than rising Europe prices. The U.S. prices seem especially at risk given the sizable inventory stocking right as we move past the winter heating season. We do not see tariff changes impacting natural gas or electricity. The lower natural gas prices seem like a tailwind for big users such as the ammonia-based fertilizer companies like CF Industries. For Europe, the pullback of price is actually just bringing prices to normal levels, not to substandard levels. Summer cooling season is unlikely to move prices from here. We'd now like to move on to our fourth industry topic, the insurance cycle. Property and casualty insurance stocks have done well year to date. The chart shows the 5 largest U.S.-based P&C companies have all outperformed the S&P 500 to date, some by a small margin like Allstate and some by a large margin like Progressive. Seems the tailwind is due to a combination of insurance stocks seeing limited impacts from tariffs and DOGE moves. Also, insurance stocks may hold up well amid another year of a possible strong upcycle in insurance. This chart shows we are now entering the 8th year of a hard upcycle in the property and casualty insurance business with more positive premium growth. Why are premiums still growing? Seems auto and home insurance rates are already quite high. Well, in defense of the insurance companies, property and casualty insurance companies have not forgotten the 2022 bear market in bonds, a market that destroyed much of the industry's equity capital and that many players are still recovering from. Also, the industry is experiencing increased frequency and severity of catastrophe losses. Indeed, the Los Angeles wildfires in January are likely to result in more model revisions and yet higher premiums. Related, reinsurance is becoming less and less available to offset large catastrophe losses. And lastly, with some level of residual inflation still present, premium increases are less challenging to pass through to customers. While property insurance companies have seen quite a bit in the way of earnings gains in recent years, we do not see an imminent softening of the cycle in 2025. LA wildfires and residual inflation suggest more premium increases this year. And with limited impact from tariffs and DOGE, the property and casualty insurance stocks actually seem like a decent diversifier. Of course, property and casualty insurance is likely near a cyclical top given record profit margins and ROEs, and there is some risk to earnings in 2025, such as possible increased claims cost and a possible reacceleration of inflation. Still, we continue to hold the line here and believe that 2025 operating earnings growth will still be positive. Our final topic for the slideshow is arbitrage spreads. Perhaps it is a sign of market weakness whenever we bring up merger arbitrage spreads. This means our clients are asking about stocks to buy that won't go down. And whenever there is market volatility, arbitrage spreads, well, they can widen despite no change in deal risk. That seems to be the case today. Of course, there are other factors that influence arbitrage spreads, with interest rates being top of that list. Also, overall merger activity level can influence spreads. Today, arb spreads are on the high side. While deal flow is not particularly high or low, we do have comparatively high interest rates and increased stock market volatility leading to higher perceived deal risk. Select arbitrage deals now seem timely. Of course, each deal needs to be evaluated on its own merits. The chart here shows arb spreads on announced merger deals that are expected to close this year. Note many of the smaller spreads on the order of 1% reflect a more imminent deal closing typically, so annualized returns are likely much higher. In a choppy market, it's useful to build a watch list with all relevant deals, since spreads can widen and narrow quite quickly despite no change to deal prospects. Opportunism, in other words, can boost returns. Some level of due diligence on deal prospects is called for, since deals that fall apart will hit the stock price and fairly hard. However, for well-selected deals with limited chance of deal collapse, arb positions are likely to hold up well in a down market. Before we conclude, we have one additional slide about how the stock market rises and falls over the long term. This chart goes back all the way to 1980, looking at the return of the S&P 500 each year as shown in green. As you can see, the average annual return since 1980 was 13.3%. That figure is actually a tad higher than the 100-year average of about 10%. More importantly, though, the chart shows the biggest rally in each year as shown by the dots in black. The average rally within a year was an impressive 26.9%. The chart also shows the average drop in the dots in red. The average drop within a year was a nail-biting 13.5% decline. The conclusion here is that the stock market is clearly volatile in the short term, but the stock market does tend to rise in the long term. Indeed, the long-term view allows investors to ride out the short-term fluctuations, benefit from compounding returns, and limit the impact of emotional decision-making. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.